Over the past few months and even years, I've been diving deeper into trading psychology, and as one will find pretty quickly, the name Mark Douglas is pretty much the go-to in the trading psychology space. There's a few other prominent names out there, but Mark Douglas, especially in the trading community nowadays after the work he's done while he was still alive, is some of the most talked about and practical advice that traders can actually use and implement in their own trading. Mark used to mentor traders from the floor, trading with huge accounts, trading with large sums of money, to even hosting seminars with your average Joe, your average investor, your average trader who wanted to up their game and to take things to the next level. And of course, pay for that knowledge. And over the years, the reviews, the results, they speak for themselves. So in today's video, I'm going to take some of the most important concepts from Mark Douglas's trading psychology, and I'm going to summarize them here for you in about 10 minutes. Now, before we dive in, a quick disclaimer, this is going to be my interpretation. I'm going to do my best to take some of the most important concepts, simplify them down so that they're actionable for you. And of course, this is not going to be at scale or at the depth that Mark covers in his 2 trading psychology books or in his paid for webinars that he's done over the years. So not taking away from those things, there will be links underneath this video if you want to check out some of his books to dive deeper into a lot of what we're going to talk about on the surface here today. But these concepts I think are really, really important because you could take these concepts away, write them down, or study them, or even some people will watch this video multiple times, re-listen to these concepts before a trading day, before a week, to put yourself in the right mindset when it comes to your own trading psychology. All right, so let's dive in. When it comes down to it, trading is a simple game. And here it is, really just 3 steps. Step 1 is you determine your risk on a specific trade. Step 2, you take the trade and the trade either works or it doesn't work. And step 3, you move on to the next trade. Overly simplified, but at the end of the day, that is all it is. It does not need to be a guessing game. It does not need to be an emotional game. It's a very simple job. Now, building off of that 3-step approach, Mark has 5 fundamental truths, and you can find these online if you ever want to look them up, or you can write them down, or you can save this video. And the 5 fundamental truths of trading psychology, or trading in general, from Mark Douglas's perspective, are as follows. Number 1, anything can happen. Number 2, every moment is unique. Number 3, an edge is nothing more than a higher probability of one thing over the other. Number 4, there is a random distribution of wins and losses on any set of variables that define an edge. And number 5, you do not need to know what will happen next to produce a consistent income. Now let's unpack this really quick. When Mark talks about anything can happen, he's really kind of hitting on this point that he talks about multiple times in his books. And that point is that the market's random. You can't come into the market and think that trading is not random. It does not mean that you can't make money, kind of hitting on point 5, right? But trading is random. The market's random. If you think that you can come out here and predict what happens next or predict what's going to happen over the course of the ebbs and flows and the Fed this and this market that and maybe this futures market, you look at crude oil, you look at these different markets and you say, oh, I can predict this. And that is not trading. That is gambling. That is someone who is trying to make a call. That's not actually trading, because what that funnels into, and I think a lot of us can relate to this, is you'll end up in a situation where you might be right for a period of time or for a couple calls in a row, and you might do very well. Your portfolio, your account might shoot up and it might do extremely well. But then you go through a period where you're wrong and you're wrong and you're wrong, and you just don't have a grasp on the market, or it's not making sense. What was making sense or what was working in the past is no longer working. And you see that happen all the time, whether it's when you're trading this market, when you're trading this style, you're trading this strategy, this pattern. There are times when they work really well, and then there are times where they don't. But if you come at it with the approach that you know what's going on, you know what will happen next, you're going to get yourself into a really tough spot, because then you can easily snowball and you can easily lose a lot more money than you think. And the consistency, gone. You have no consistency at that point in time. So removing yourself from this thought process that, oh, I can figure out, oh, I can time the market, I can do this, I can predict, to I can't predict. I am going to build out an edge, a systematic approach. I'm going to, and there's a million of them. You can trade any way you want, whether it's these indicators, whether it's smart money concepts, whether it's this pattern, it doesn't matter. As long as you have a trading edge that you can rely on, that gives you just a slightly higher probability, a slightly higher chance when you flip a coin that you're going to be right, that it's going to land on heads if you pick on heads, right? Then not. That is all you need to make money and be a consistent trader and produce a consistent income. You don't need to know what's going to happen. You don't need to know what trades are going to work because there's no way to know. And if you think about the market from that perspective, by understanding I don't know, I don't control things, I can't outsmart the market, there'll be times where things make sense and I understand, I could have predicted that. And then there are times where it doesn't make sense, but if I just trade my strategy, I just trade my edge, the probabilities are in my favor anyway over the long term, so who cares? Building off of that, when you take a trade, here's what you're actually doing. You are relying, because once you're in, you're in. You can't do anything. You are relying on the perception of other people to move the market. Think about that. You have absolutely no control over where it goes. The only thing you have control over is where you take profit and where you stop out. And so as long as those two things are consistent and they make sense from a risk management perspective, that's all that matters. Because again, you have absolutely no control. It's out of your hands. Once your position is on or off, it's out of your hands. You can't do anything. It's done. It's up to the perception of other people, other market participants to move price. Okay, cool. So what about if I'm wrong 5 times in a row? Yeah, that's possible. What you need to think about, and what Mark really hammers home, is you need to be thinking about your trading over the course of many trades, whether that's 20, 30, 40, 50 trades. Depends upon how active your style, if you're swing trading or if you're day trading and whatnot, how many trades you take in a day. You can't look at it as, I took 3 trades and they were all losers, my strategy sucks. That's not a big sample size. That's not a big series of trades. You need to take a series of trades and evaluate your trading edge over a series of trades, whether that's 20, 30, 40 trades. Then from there, you can understand, do I actually have an edge? And what critiques need to be made to my edge to put me on the right side of the probability scale here. So when it comes down to it, it's really just a numbers game, and things like technical analysis can give you a higher chance, a higher odd of one thing over the other. Again, though, on a series of trade, not this trade. This trade that has this setup that you look for could totally go against you. Doesn't matter. But over the course of 10, 20, 30 trades, check how many times that setup will work or not work, and then you can evaluate that edge. To bring it home, there can be no subjective decision-making whatsoever. And I think Mark does a great job of hammering that home. Because at the end of the day, if you start to think you know what's going to happen, right? It brings it back to that same concept. You've already lost. You've already lost because now you are trading with either emotions or you are trading with the thought that you think you can control price or that you know what's going to happen next. And when you start trading that way, you remove yourself from playing a probabilities game to start playing a game of guessing. And that is not what trading is, and that is not what a consistently profitable trader does. There you guys have it. Hopefully this video was helpful for you. Again, those links down below if you want to check out and go deeper into Mark Douglas trading psychology. Those 2 books will be in the video description box below if you want to check them out. Thanks so much for watching. If you guys got something out of the video, hit the thumbs up button, consider sharing it with a friend. And I know some of you might want to come back to this video and watch it again because I think these concepts are really important to hammer home in your own trading no matter what markets you trade. Thanks so much, and we'll see you in the next one. Peace.